Good afternoon and welcome to today's webinar hosted by the National Network of Credit and Financial Professionals. I am here today with speaker Richard Hastings, macro strategist, who will be presenting on tariffs, settlement rates, autos, housing, and Amazon effects. A few items to get out of the way before we begin. If you have any questions during the course of the presentation, you can ask them through the questions function on your side panel. We will gather all those questions and save them for a Q&A at the end of the presentation. If you were looking for a copy of the slides to follow along today, they are not available, but we will make them available after the presentation. We will also be sending a copy through email after the presentation is complete. The last item is that we will have a brief survey that pops up after the webinar ends. It only takes about 30 seconds to fill out, but it gives us a lot of great information on how we can continue to make the webinars better for you. Now, Ken Frisco will give you a brief intro of our speaker.
Thanks, Sharon. Just a brief background on Richard. He's the macro strategist for international investment bank Seaport Global Securities. Richard monitors trends in domestic and international markets, specifically energy and weather, demographics and housing, new ideas in IT, Internet of Things, and artificial intelligence, especially Amazon, are some of his most frequent themes. So at this point, I'd like to turn the presentation back to Rich to begin his presentation.
Thank you, Ken, and it is so much fun to be with everybody today. If there's any technological problem, certainly let us know, and we're going to figure it out. So I'm going to start to move the slides along over here, and you should see a disclaimer screen. Let me check with Ken to make sure that you see that. Is that correct, Ken?
That's correct.
Excellent. We're going to move right along, and you're probably wondering why? Why do we have Walt, of all people? But you know what? Think about it. We had an incredible election, a revolutionary event. We have Walt in the White House. So it's a totally new world out there. And, we're attempting to do things a little bit differently. And Walt is very relevant now. So let's move along. And it's a fun movie if you've ever seen it, very entertaining. But let's keep him in mind as we move along to slide number 4. Oh, the tariffs. Clint Eastwood, Walt, dirty tariff. So let's take a little bit of a thought about the relationship over many, many years between trade, production of a big, dirty, old industrial metal like aluminum. I mean, this stuff it gets nasty, and the relationship between that, world trade, and funding, the way the United States has been funding itself, and many countries, deficits are normal, and to run a deficit is not necessarily a strange thing. Some may object to the concept, but it is a relatively benign development in how very large countries fund themselves. And the United States, especially with its complexity of international trade, is always able to go around the planet and to seek funding from very liquid, low-cost sources. And one of those, a long time ago, was Japan. And when it was no longer Japan, then it started to become China. And this is not the first observation of this. We've seen this type of phenomenon looking at global trade and the funding of U.S. Treasury debt through trade and through production of big industrial commodities overseas, and how they are able to generate foreign reserves from trade outside of their countries with exports back to, whether directly or indirectly, back to the United States, and how we fund our deficits. So when President Trump starts to talk about tariffs, you're kind of starting to tinker with a very delicate subject, because the ability to fund treasury debt. And that's how you fund all of the massive entitlements and everything else that are very difficult to change. The structure of society is built around them. You can start to tinker with those and peel back some of them. If you do too much at once, it can be very dangerous. You can do a little bit at a time. Some of it was controversial and unhappy in the earlier years of the Reagan administration, and he did so much of it in his first administration that he actually slowed down the economy, and then things got better after that. But there were dislocations in society that lingered for many years thereafter, ultimately leading to a big change in the political outlook, and that's how you got President Bill Clinton. So we're seeing these kinds of swings back and forth, and now we're trying to do this sort of thing again, this time more aggressively, talking about tariffs, aluminum and steel. So if we wanted to really get aggressive about, let's say, just aluminum, which is a 10% implied tariff, and then steel would be 25%, and we don't really import necessarily that much of this stuff directly from China. Instead, there's a back way for this to happen. It can go right through Canada, indirectly through, intermediate finished or unfinished goods coming into the United States. There's another way for it to happen. But you start to mess around with this, you're messing around with how we fund our society and our treasury debt. If you want somebody else to make up the difference, they may not have the size and liquidity to do so, and they might require a higher interest payment. So therefore, the interest rates might be pushed higher. That, of course, is always possible. We used to live in a world of much higher interest rates a long time ago, until we discovered this very liquid, low-cost funding mechanism that was first Japan and then China, and Japan still plays that role as well. But if we want to really tinker with China too aggressively, I think that we should be prepared for negative repercussions. Retaliations would be only one piece of it, but we would have problems finding alternatives to that very liquid source of funding. If we want to really not have a problem with that, we could just really cut back on enormously many different kinds of discretionary spending, things that glue society together. And you don't want human beings to get too upset. They have a way of really going berserk. Walt. See? Walt is back. So, you don't want to take away too many entitlements from the structure of society too fast, in the same way that you don't want to really walk on Walt's lawn. Slide number 6, auto loans. Walt. Well, you know what? As of late last year, the data was coming out of Equifax that provided their credit data on automobile loans to the New York Fed, and I focused my attention on the lower quality tiers of consumer credit where the scores were lower. And I started to pick up a pattern, played around with it a little bit, ran a little bit of a statistical trend. There's a little bit of a method note in the upper right-hand corner. I took the latest quarter and then whatever the variance was of that quarter from the latest 3 quarters moving average. You just kind of have to goof around with some numbers sometimes to see what you get. And what I found was that this automobile loans, it's an enormous part of the economy, really, really big stuff. The automobile thing is big. And it's basically spread out between auto finance companies and banks directly. And the information from the credit scores showed that the auto loan originations in the lower quality tiers below 660 FICO scores were really starting to slow down and even going into the negative. So I would expect that as interest rates have gone up, we'll continue to see less participation from the lowest FICO scores in some areas of consumer credit. And that can start to very, very slowly bear down upon the macro economy, and that can take many, many quarters for it to really filter through to GDP. So looking at this alone, that's a pressure point. So we're identifying a potential pressure point, and with interest rates having gone up since this time, we have to hypothesize that this may continue to be the case, and then that means that other areas of the economy have to pick up the slack to offset some of the drag coming from something like this. So these below prime, it's not all subprime, which is a small slice of the pie, but the below prime universe of automobile loans is a signal that higher interest rates and just outright consumer fatigue. I mean, things have been, expanding for a long time. It's not like we're in the second inning. It's a little bit mature. We're probably in the sixth, maybe the seventh inning, and maybe we'll go into extra innings. That's okay also, but we have identified a pressure point. Keep it in mind. Slide number 8, a little bit more evidence of the cycle starting in the third quarter of 2010. You see the uptick, and interest rates were fantastically low. You had the QE system, quantitative easing, and it was all designed to get participation from the consumer back into the loan system, whether housing or automobiles. But basically, things had broken down pretty bad, so you had to really, jumpstart the whole thing with like a really, really serious jolt, and it kind of worked. And then it kind of, leveled off, got a little bit better 2015, and you can see on the far right-hand side over here on slide number 8 that we are cycling down and we're starting to slow down. So the participation from below prime originations as a percentage of all auto finance loan originations, there it is. The evidence says we've peaked out, it's matured, and now you have less participation from below prime. It happens. It's a normal cyclical thing. It's not a recessionary level signal at this point, but that means that one major feature of the macroeconomy has topped out and is starting to decelerate. That means it's not growing as well as before, or it may have just peaked out and now it's going to start to downshift a little bit. So we'll keep an eye on it. Something to think about. Slide number 9, further evidence of the importance of this subject, loan maturity. So what you could do is you could take your average maturity of your loans, stretch them way out into the future, 60, 70 months, whatever you want to do, and really extend the period of time. But it really hasn't done that much to improve the situation of below prime. Delinquency rates have been steadily climbing, and once again points to deteriorating conditions in the lower quality part of the consumer credit universe. Just something to think about. The tax reforms will help out with that. Retail gasoline prices have been steady and affordable. Those are positive offsets. Job market is good. Those are positive offsets. But here is a point that has weakened while the other things have gotten stronger. So a lot of different things to consider. Slide number 10, let's think about the extent of the automobile loan marketplace going back many years. Well, it's went through a big expansion cycle back in, that famous period of time before everything kind of cracked up. And, some of that was just good times, home equity credit, just the overall quality of the economy, participation of households and things. And things kind of got a little bit overheated, and then the credit system just cracked and stopped functioning and had to be jump-started and brought back to life. And, that took a few years, and then finally about 2010 it started up again. You can see in the upper right-hand corner the evidence that the cycle has gotten pretty hot again, and auto loans definitely suggest that there's a possibility that this cycle will get tired. When we zoom into it, slide number 11, it's been absolutely unbelievable. So if we go back to the third quarter of 2010, when it really started to recover and take off again, automobile loans grew in just this period of time from Q3 2010 to Q3 2017. And that is, a long period of time, but that's $410 billion or about $163 million a day grew about 52% in that period. That's about as crazy as it gets, and it'll start to slow down a little bit from here. And when I say slow down a little bit, not in a bad way, but we'll keep an eye on it. So this is an important contribution to figuring out what is the big story in the macroeconomy, and that's why we started off here. Number 12, I have help. That's right. We have Walt and we have Will. Will is so interested in anything like this. He loves all this magical economics, all of this hypothesizing, and he wants to hear what else we're thinking. So, yes, we are going to continue to prophesize. Okay, Will. All right. Slide number 13. Let's take a quick look at housing and wealth effects. All right. Well, things change, and we've gone from a world where it was the ownership society, and you know what? The paradigm of the ownership society is really starting to change. Just think about the concept of Uber, Lyft, and I don't know if you've seen the TV commercials that Enterprise rent a car. Well, they do more than rent a car. They are supportive of different kinds of systems that include transportation as a service, TaaS. That's a big development. So nowadays, there's the ability, thanks to network systems and due to the strength and flexibility of databases, interactivity of databases, well, you can basically take any kind of typical thing and turn it into a service. And the idea there is, well, I will call you for that service when I really need it. And that is a change in the concept of ownership. And it's not just the cost of a house. Some of it is just the mentality of home ownership. Yes, the money is a piece of it, but a lot of this is starting to turn into an outright rejection by some younger people of this concept of, you know what? I don't have to own it. I don't have to have that. There's other ways for me to enjoy my life or to do my life, and ownership doesn't have to be at the center of it. So one of the interesting long-term side effects has been that the ownership concept took a really, really big hit from years ago from the credit crash. So with that being the case, we can see the home ownership rate among those who are 35 years and younger between 1994 and 2017. It peaks out along with the rest of the housing market in about 2005, 2006. And even though it has stabilized and recovered a tiny little bit, very, very little bit, it is way down from where it was and well below the long-term average for the period that we're observing, 1994 to 2017. And I don't think that's going to change that much. There's a concept among those who are really involved in the housing market. They want to believe that, oh, well, all these younger people, there's so many of them, there's X number of them, and we are seeing the studies that 20-something% of them or 40-something% of them are going to be buying a house over the next blah, blah number of years, but they're not listening to how the younger people are really thinking about ownership. They don't want to look at it. They don't have to look at it, but I do. And the evidence says they're not into it. Let's take a look at slide number 15, home ownership rate among those who are 35 to 44 years. You know what? Same thing. You got a whole continuation of the same problem. So there it is, way below long-term average. The ownership concept, it's not just money. It's not just interest rates. We already tried that. We've tried super low interest rates, things like that. Well, because of so many different things that happen to the housing market, tight inventory, change in, the concept of ownership, not enough cheap inventory, more expensive to build a new house, passing along the cost to the prospective buyers. Wow, all of a sudden it's like just totally unaffordable for some people. And then meanwhile, they're thinking and they're looking at each other and they're like, you know what? We don't need to do this anyway. There's so many other options. So there you have it. Just two gigantic age tiers saying no to home ownership. It's a big deal. And what's going on behind that? Unfortunately for the United States, we are the kingdom of severe wealth inequality. You know what? We are absolutely untouchable when it comes to this stuff. Oh yeah, we're so good at this. All right, let's take a look at the shares of income in the U.S. Starting in 1938. That's our starting point, and the percentage change in those top tiers. Looking at the top 10%, top 5%, top 1%, top half of a percent, top 0.1%, tenth of a percent, and then, of course, the granddaddy of them all, the true one percenters, the 1/10 of 1% or something like that. You know, it's basically that tiny little slither, and they have a lot of money. And you don't have this in any other major consuming country on the planet. So, starts in 1938, Great Depression, World War II, and then we kind of figured out how to have some sort of a middle class expansion, and that goes on for years. Then, all of a sudden, you go into the latter part of the 1980s, and I made a little bit of reference to that when I started to talk about deficits, entitlements, treasury funding, and what went on in the 1980s. And there it is. And it's only gotten worse and worse and worse. And we had a progressive presidency for 2 terms. And then because of the severity of the wealth disparity in the United States and the frustration of so many Americans, now we have Walt. And that's what happens in American politics and finance. It swings back and forth between these extreme efforts. And sometimes, put it to you this way, they're all totally unsuccessful if you give it enough time. And here's the evidence that we've had wealth disparity severely going out of control for decades, and nothing's going to fix it, unfortunately. So when you look at the housing market statistics and the mentality regarding ownership, well, if you only have a certain number of people with enough money so that it's really a piece of cake to do and logical to do, and you don't have enough newer population coming into the pipeline to become the homeowners, well, then there is your answer. There it is. Let's see if we can find more evidence. Slide number 17, the home ownership rate on a total inventory basis. It's a little bit more of an aggressive number than the Census Bureau version, and it's finally started to wake up from its all-time lows. I think it was in 2016, and it's way, way below any decent level in the past. Wow. Interesting, the last time it went down the drain was in the 1980s when interest rates were fantastically high and other things were going on. Slide number 18. Wow, that was a big subject, guys. Let's take a look at sentiment. How do people and institutions feel? Let's see what they say. Well, if we ask full-time workers only, and the funny thing about surveys, it's a kind of a funny thing, whether it's the University of Michigan or the Conference Board or this or that, a very high percentage of responses are coming from people who are retired, unemployed, part-time, disabled, and other kinds of, variations differently from full-time workers. So if we only focus on full-time workers, we should do that for this study. And what we see over here is, let's pay attention to the gray, that black line, and that has gone to record highs in this measurement, and that's a really, really strong signal. Wow, that is a lot of confidence that, the economy is going to be strong. And then the orange-red type of line going way down is usually a much bigger measure. But with that thing going down nearly to 30% and the other one going up to about 20-ish%, they're not even that far away from each other. I mean, I don't even have to do a two-axis chart pretty soon if it keeps going like this. So I apologize for the two-axis chart. They're terrible. But in this case, I did choose to do it this way. The red line refers to the numbers on the left. The black line refers to the numbers on the right. And these are record numbers. This is behavioral, attitudinal, psychological stuff. This is what they feel. This is what they think. This is how they view things. They may not have a lot of money. They may not be buying everything that they wish they could, but their attitude about the economy is very positive. This is a very encouraging situation. And one way to look at it from here is you got a long way to go down. Yeah. Deferred home improvement. Let's take a look at slide number 20. So, going back to 2003 and going across all responses, whether they're working full-time, part-time, retired, disabled, unemployed, doesn't matter. We're listening to more than 7,000 shoppers a month here through February of 2018. And the lower this number, the better. So the people who are saying that they deferred spending money on home improvement in whatever way, shape, and form over the last 30 days, you want that to go down. You can see that, it peaked enormously right around the middle section there when you had $4 gasoline, and then the credit system was just, like cracking up, and then all of a sudden, the jobs just died. And this thing was bad for years. And then you had the Arab Spring, and you had very expensive gasoline prices all over again. The job market was getting better, but it wasn't that good. Wealth effects were really bad. And then finally, you start to get towards about 2015 and 16, gasoline prices start coming way down. Job market was starting to improve. Things were, start to get better. And then you got a lot of optimism associated with the President Trump election in 2016. That really created a big burst of optimism. And that shows up in that downward spike because, again, this measure here, the lower, the better. So that's encouraging, and that's important. You want to see a good home improvement type of sentiment. You want to see evidence that the system is cycling money and wealth and home equity back into spending on houses. It's not just here. Let's take a look at, the European Union, the EU. So we got the two big groupings, the EU 28, which is the extended European Union of 28 countries, and then you got the Euro area, EA, and that is the group of the EU that uses the euro currency. And if you think that's complicated, believe me, it's worse than that. There are so many different groupings inside of the European Union. It's unbelievable. But you know what? If you win the Powerball, I don't think there's anything wrong with spending the rest of your life in the Swiss Alps. It looks nice. Think about it. The EU, confidence, really a very, very good looking set of numbers over here. It took a long time for this to happen. They were down in the dumps for a long, long time. We were starting to regroup, and things over there were just awful. And they're back. Europe has really, really rebounded, and the sentiment numbers coming out of there, economic activity, it's all pretty good. So that is important because what we make here and so many companies here, we have to do business over there. Indirectly, companies in the United States that have their manufacturing in Asia, they're going to export from Asia into Europe. Europe is the biggest population economy on the planet. As a union, the EU 28, in terms of population, is much larger than the United States. GDP per capita, we're bigger, but when it comes to just total size, they are the biggest market on the planet, and if they're healthy, then it's good for Asia, indirectly good for us. So that's a good one. Let's take a look at export orders that came out of the survey of manufacturing companies done by the Institute for Supply Management, the ISM. So what we're looking at here, we're only going to look at the survey responses that say that export orders were better. So there'll be a diffusion number, like an index number. There'll be percent better, percent same, percent lower or worse. In this case, all I care about is how many of the responses say better. You want to look at that. And that's what we're looking at, and it's a beauty. The latest survey results for February, U.S. manufacturing companies responding with the biggest uptick in export order sentiment in a long, long time. Yep. I mean, we haven't seen stuff like this since 2009 and 2010. Very strong number, big uptick. It's good. And that combines with what you just saw in the European Union stuff. It all glues together. If things are better for the European Union, then our companies that are exporting to Asia or directly to the European Union, it all glues together, and that's a big positive. That offsets some of the negative that is slowly percolating from the slowdown in consumer credit contribution from the lower tiers of credit scores. It's a good thing. So what the heck was going on with the stock market recently? What was that? I mean, really, what on earth was that? Slide number 23 and 24. I'm going to explain it to you. Oh, one of those kind of charts. Okay, I got a lot of explaining to do. Okay, it's a yield spread. Yes, a yield spread. Okay, so over there on the left is kind of like the spread, whether it's 1.0 percentage points or 1 point or point, half a percentage point or more than a percentage point. So as the short-term interest rates start to go up, the spread of the short-term interest rate over things like the dividend yield in the S&P 500, the spread will start to narrow. It'll go down. As that goes down, the stock market starts to look at the value of the dividend yield of actually owning a stock that pays a dividend. And the institutions that are the big smart money on the planet start looking at these yields and yield spreads, and they start to say to themselves, you know what? I don't think we should really own that much of this stock anymore. We're going to sell a little bit. We're going to reduce our exposure because the yield spread is going away. And as that started to happen months and months ago, they started to watch this stuff. And then, you just wake up one morning and it's like Monday morning, and then, the whole stock market, all the big institutional money, they all just wake up and have the same idea at the same time, and they push the enter button, everybody at the same time, and then, wow, just there's nobody on the other end, to pick up the slack. So that's a little bit of what happened in the stock market. For many, many years, investors were piling into safety things, whether it was bonds or Apple or things that paid a dividend, and all of a sudden with those short-term interest rates going up, they're still going to go up. Things like this start to become a question. Yeah. Let's take a look at my favorite subject. Slide number 25, almost total disruption. Before we get to Amazon, I want you to think about this. When there's a wave of leveraged buyouts in an industry, it frequently means that that industry has already gone into some sort of state of maturity and maybe even some decay. And in the U.S. textiles industry, and believe it or not, there's some of you that probably weren't even born when this LBO wave happened in the early and mid-1970s in the U.S. textiles industry. That was a sign that things were not really that good in the United States making that kind of stuff. And then, sure enough, by the 1980s, they were having to do second LBOs, and then they started to do bankruptcies, and then they started to, restructure a little bit in the 90s, and, it's pretty much gone. It's in Asia, and there's a little bit left in the United States. The retailing industry in its totality in the United States has been old for a long, long time. Some of these companies have their origins, holy Toledo. Lord & Taylor was founded in the 1820s. Macy's was founded in the 1850s. Sears was founded in, I think, the 1880s. The list goes on and on and on. The concept of retailing, of doing stores, store-based things like it was starting to get into trouble a long time ago. And when an industry starts to go into post-maturity, it will attract management that's not necessarily the best, not necessarily the most innovative. Oh yeah, they can use words like innovation and creativity and stuff like that. That doesn't mean that they're doing it or that they even can afford to do it. And while they have all been in a state of post-maturity for a long time, you've got the new-born things that are born into the future, like Amazon, and there's no old kind of infrastructure there that can hold them back. So it's a beautiful intersection of the old and the new. And out of that, you've got just incredible new things going on. So if we think about what I said about the yield spreads and safety in the stock market, let's take a look. Slide number 26. You got 3 lines there. This is actually not that bad. The gray line is the market value of Apple stock. Massive safety trade, innovation, creativity, kind of new, and maybe not. And then all of a sudden, in the meantime, the black line down there just kept going up and going. It didn't have any ups and downs, just kept going up and up and up, and that's Amazon, market value of Amazon. And then in the last, just 6 to 9 months, look at the way the market value of Amazon went up in an absolutely nearly exponential way. And if you run the spread of those two, Apple minus Amazon, you wind up with this unbelievable collapse where there's really not much of a spread left in that number. So as that started to happen, part of what happened in the stock market was an enormous wake up that Apple itself, which had been really the rock solid foundation of so much of the system, had a couple of cracks in it. And it was Amazon really exerting its strength and its power and its disruptive capabilities into things that nobody even suspected. Let's keep looking. Slide number 27. Brand Finance does the estimates every year of the value of the biggest brands on the planet. Amazon is now the most valued brand on the planet, 2018, slightly ahead of Apple. That rebounded after a bad 2016-2017 transition. After them, you got Google. That's logical. And then Samsung has climbed unbelievably in a short amount of time. And Facebook, of course, is an enormously valuable brand. Let's take a look at where these guys were in 2017. Google was number one with a little more than $109 billion in brand value. It had grown by 24% year over year. Apple had taken a dip of 27% and was just slightly below Google at $107 billion. Right underneath that, with very, very little difference, was Amazon at $106.4 billion. But look at the growth rate, and that's all you had to look at. If you were only about, even $1 billion away from number two, and you were growing at 53% and they were declining, well, if you adjusted that so that Amazon was growing by 25% and the other one was growing by 5%, it was game over. It was a done deal, and that's why we get to. And take a look down there at Walmart. Already was $62.2 billion in value, was still growing. Let's go to slide 29 and look at what's happened. Amazon's number one on the planet, valued at $151 billion, growing 42% year over year. Apple rebounded, grew 37% after a bad year over year delta in the previous period. And look down there, Walmart has declined by 1% year over year. ICBC is a big bank over there in China. For those of you wondering, what is ICBC? It's a big brand in Asia. So this is the new world. And basically, it's kind of like the FANG stock concept of Facebook, Apple, Amazon, Netflix, Google, Microsoft. It's really, for some people, that is the stock market. And there are many days where, you know what? It kind of is. And everything is shifted over to these service, entertainment, information types of newer economy things. Well, take a look at the housing ownership stats that we saw earlier. Well, there it is. It's a totally new world. Slide number 30. Walmart's brand value. We went from 58.5% of Amazon's in 2017, and now we're down to only 40.7% in 2018. An enormous decline relative to Amazon. Big deal. Slide number 31, I am getting a message from Chris. And Chris, he's kind of objecting, and he's saying, wait, I thought Walmart was big. Chris, Walmart is big, but growth is a different thing, Chris. Let me show you what I mean. Let's take a look at Amazon versus Walmart relative growth rates starting in the third quarter of 2011. Down there at the bottom, that orangey red line, again, this is one of those indexed growth things. It starts at a certain point in time, and then we keep going from there. So what is the percentage change ultimately from that starting point? The Walmart thing looks like it's barely even changed. They're big, though. They're big. Now, Amazon, we got two line items that we can look at. We can look at their services, which has grown enormously. And then we can look at Amazon total. Difference between Amazon total revenues and Amazon service revenues is you've got Amazon's products and digital products that they sell to me. So I'll order, let's say a keyboard for my computer from them, or I'll order a book from them, or I'll order, cables for the home office or something like that for them, or a million other products. Or I'll have Amazon Prime and, order a movie for $5.99, or, some sort of a music thing. And, those are all of Amazon's product revenues, whether it's a physical thing or a digital type of product. Then there's Amazon services that they sell to all the companies that use Amazon for web services and all of the delivery related services if you use them, for delivery. So let's say you're a little vendor, you can use Amazon. You can do the pick and pack and delivery yourself with Amazon as the hosting service, or you can go 100% into the Amazon Prime system and, fulfilled and delivered by Amazon. You can go that way also. Costs you a little bit more if you're the vendor, but then you get a little bit more branding. It depends on your liquidity capability to do that. But you're seeing the relative growth rates. Oh my goodness. Walmart so much bigger, retailing so much bigger, Amazon growing so much bigger. Yeah. Yep. Let's take a look at slide 33. Another one. Amazon as a total percent of Walmart's sales. Now, this one is not a relative growth rate comparison. This is just what is X as a percentage of Y. Amazon's total sales as a percentage of Walmart's total sales, the black line up there at the top, has gone from about 10% to about 35%. And you and I both know that that's going only higher and higher. Amazon's product sales, I defined that a minute ago as a percentage of Walmart's net sales. That's gone up from almost 10% and now is getting close to 25%. It's only going to go up. Amazon's service revenues as a percent of Walmart's total sales. Now, that's a smaller number, but it's already creeping up, and it's about 10 and it's going to be 15%. Oh my goodness. It's just unbelievable what's happening. The consumer participation in spending money on retailing, not a problem. That's not the problem. The problem is that we've changed. People are different than we used to be. You know what, folks? If you give people devices and you change the environment around people, they change. And we're changing. Technology changes us. Part of the reason why home ownership is not as attractive, give a man a tablet and he's happy. Kind of scary. Chris Christie has another question on slide number 34, and he says to me, hey, now I'm wondering. And he's right, because it really starts to make you wondering. So let's take a look at what he's wondering about. Amazon and retail sales, let's take a look at the numbers. You might have seen these somewhere else. So Amazon as a percentage of X Autos retail sales, well, in the last quarter, the fourth quarter, which is the big holiday retail sales quarter, was about 4.8% of X Automobiles retail sales. It's not really that big. Now, of course, it's growing, and you can see the growth rates over the years. Wow. Back in the fourth quarter of 2009 was only 1%. So it's increased, but we're not even at 5% yet. Of course, we're going to get there. And it's like, I don't get it. It's not that big. Well, because people, they're still buying stuff. And Amazon, as a percentage of the gigantic universe of retail sales, is not that big. But when you take a look at slide number 37, and then you go into Amazon as a percentage of all of the non-store retail sales universe, online, and whatever you want to call it, non-store. Well, you're almost at 33%, and it's growing fast. That means that you're looking at a situation where Amazon's total sales, and that includes their services in addition to their product revenue. So it's a little bit unfair. We could take it apart and do it the other way, where just their retail products were 19% of non-store sales. But if we want to be aggressive about it, and I think this time we do, we're at about 33%. And we can easily go from here and say we go from 35 to 40%, because there are so many other companies that cannot afford to do non-store direct-to-consumer as efficiently as Amazon. So right now, Amazon is in that period of time where they will gobble up market share very, very easily, and then maybe later on it'll change. But for now, we're in a period where the world of direct-to-consumer, non-store, online retailing is going to be increasingly dominated by one company. That does not make it a monopoly. And if you go back to slide number 36, it would be very difficult for the government to argue that Amazon is a monopoly, because when you take it and throw it against all retail sales, it's just not big enough. Even Walmart's not big enough, and they're bigger than that. So you're going to continue to see, in our opinion, Amazon gobble up more market share. The realm of inefficiency in the retailing industry, unfortunately, is pretty big. A lot of these companies, they cannot do it. They're not set up. They're trying. It's not going to happen. And that means that the cost to acquire another unit of sales from somebody else keeps getting easier for Amazon, not harder. So you're going to see this number go up 35 and then 40%. Yeah, could you get to them being half of all online retail sales? It could really happen under a more freewheeling kind of administration like the Trump administration. Certainly nobody's going to go near it. And then, the argument that I made before, as a percentage of the broader universe of retail sales, not big enough. So it says something about what has happened in that newer period of commerce. And Amazon represents a new way for business to be done. Direct to consumer, D2C, in many ways is more efficient than the old retailing store-based universe really ever was. So, a couple of concluding comments before we think about what's next. Amazon represents severe radical disruption, partially because so many of the other systems were getting old and we didn't really know it. They were in a state of post maturity. Some of them, some individual companies, were already in a state of significant decay for many, many years, kept alive, kept going by sheer liquidity, private equity money, and other things. And the consumer has always been there and is still there. But with that being the case, Amazon represents a new way for commerce to be done. And it kind of connects us back to that thing with the home ownership and wealth effects. It's like there's a part of the United States that it's really looking at wealth effects and saying, you know what? I'm not going to do that. I'm not going to worry about that. I'm going to worry about the quality of my life. I'm not going to try to own a house. I'm going to have a habitat. I want a different kind of habitat. I want to have quality of life. I can't achieve home ownership. It's too expensive, too many problems, and I don't want to live that lifestyle. And one day, it's going to spread to automobiles too. So if I were going to make a really big Shakespearean prophecy, new word. I think I just invented a new word. It's good. Okay. I would say that, the home ownership thing is going to spread to automobiles. You'll see more and more adoption of a concept in dense cities where some people are only going to have automobiles as a service. It's not really that hard to do, and maybe on a total cost basis over time, may not be that, it may actually cost a lot less than trying to own a vehicle for some people. So let's see what is next. And you've noticed that I've had a lot of help from people in New Jersey. So I'm going to ask Henry. And Henry says, you know what? This bothers me. If you ask a wise guy a simple question, that's what you get. I ask him what's next, and he's sitting there and he's laughing like that, and he just says to me, "What's next? 2019." And it's like, hey, you ask that type of person a question. Why would I do that? Anyway, with that, I am actually done with my presentation. We're at about 2:55, so we're right on time to turn it back to Ken and Sharon and see if you guys have some questions. So I am done with this presentation, and we're going to do some questions and answers if you've got them.
Sharon, is there any questions? Hello?
Well, Ken, I can hear you.
Oh, okay. I guess Sharon got cut off. Rich, the only thing I guess that would be a question is the fact that is there a major takeaway that the audience can focus on from your presentation today? What's the major takeaway from this presentation?
Number one is to keep an eye on the participation of lower quality credit. As interest rates go up, you should start to see a little bit more tightening up in the whole system of lower quality credit. I'm sure the credit managers are already experiencing that, and they're taking care of it, and they're starting to see probably the beginning of a little bit of pressure. And it doesn't mean that sales would be reduced. It just means that the terms of sale would tighten up a little bit, and they would be monitoring some of these lower quality borrowers a little bit more, because the lower quality borrowers, it's going to start to cost them more to be who they are and to do what they want to do. You may not see that as a seller of merchandise credit to them, but on their side, they're going to start to see a slowdown from unit sales in the lower part of the consumer credit universe, and then the pressure upon them coming from higher interest rates could hit them in a different way. This is a slow process. It's not fast. At the same time, we saw very, very good sentiment in the relationship between the EU, the United States exports. That was a very, very positive signal. The sentiment regarding home improvement was a very positive offset to some of the negative thing that we saw with home ownership. Home ownership may not be that hot. Wealth disparity in the United States is very bad, but the attitude about home improvement was very positive, and that was a big positive offset to the problem of, home ownership rates. Going deeply into it, I think we now understand a little bit better that Amazon, is it really disrupting things because of what Amazon is doing? They're not trying to disrupt anything. I think what you're really seeing is that other businesses were in a state of much more serious decay than anybody knew, and all you had to do was throw a little bit of change into the system, and these things are just crumbling away to the side. There's no problem getting the merchandise to the consumer this way or that way, but a lot of the companies that were built to do that, they are just not going to be around. And it's happening more frequently. You see these news items. You saw the thing about Claire's. You see the thing about Toys R Us. There was a little headline about Dick's Sporting Goods, not on that level, but you can see it. It's pretty widespread. The retailing industry has been maturing, and is, a bunch of members of the industry, they've been in difficult shape for a very, very long time. Throw a little bit of disruption in there from a big change in how commerce is being done, and these things are really having a very tough time, and a lot of them are not going to be there. But the state of things right now, I would say, is good. I would be a little bit concerned about the slow, gradual deterioration in lower quality credit as you go into the end of the year and maybe early next year. I would be concerned about fiscal policies regarding tariffs if they want to get too aggressive and start cutting back in social entitlement things, programs, healthcare, and really start to take apart the system. Some of that is difficult to do too much at once, and there can be negative repercussions from that. I would be very careful about that. Rising interest rates can damage the valuation in the stock market, and you could wind up with a stock market that gets wobbly, doesn't go anywhere, and could even go down if interest rates go up a lot more, concurrent to more inflation. And inflation right now is not that bad, but some of it is slowly percolating up. So overall, it's a good situation. It's a good question, Ken, to summarize it that way. I felt it was more fun to kind of like portray it this way, but it's an excellent way to summarize it. It's really currently a good situation with clouds on the horizon that are identifiable.
Okay. We don't see any more questions, Rich, so at this point, I guess we'll end the webinar and thank everybody for their participation and dialing in, and thank you, Rich, for a very informative presentation to all of us.
Excellent. Thanks, Ken. Thanks, everybody.
Okay,
Speak to you
soon.
soon.
Everybody. Okay. Bye-bye.